but maybe this one then. They have a piece. I'm gonna go back out and see if I can zoom in. But yeah, it's like it's house. Oh my gosh. I know.
I still remember my grandmother's house.
That's what we found. So how do it? So it's not a dairy farm. They have all kinds of like horrible chores that they have to do, and we were like, yay, because we were bored.
Because you didn't grow up like that. Or even me, look.
We still have so much. Oh, very clear on that. You can see there's nothing. Yourself and write it down, just go keypad, $20 or $25, whatever it is.
Oh, my goodness.
You know, that buy the dip, that price action looks a little bit tentative right now. It looks like we're kind of holding out for Micron's earnings, which is likely to be the next big test and sort of event risk for this market. What are you expecting as far as the reaction here? I mean, what kind of moves could we be looking at kind of this time tomorrow, depending on what they say tonight?
Gosh, so the implied move is around, what, 11-12%. The stock last quarter blew the doors off the numbers and guidance, but everybody expected it. So the stock was at 460 back in late February or early March. Then the stock dropped about 30% because it was basically a sell on the news reaction. Earnings revision estimates have been positive going up, of course, over the last couple of months. If you look at all the channel checks, read-throughs from all the pricing, Apple just raised their prices. Everything looks great in terms of the pricing dynamics, and they can put whatever price they want at this point in time. But the expectations are, obviously, the stock price is nearly tripled, that they're going to blow the doors off the numbers. So everybody expects that. I don't think there would be any negative surprises in terms of guidance, but the street will be very sensitive to any of that. So, gosh, what do I expect? I think given the context of the environment that we're in right now, where I think the bull-on trader, the animal spirit, got a little bit of a right hook, with yesterday and with the drop in the Kospi. And so if you're levered up, if you're, been on this realm of buying the dip and everything, I think you have to be a little bit cautious regardless of what they report. But I think the AI infrastructure play is intact. There's no indication that demand is weighing or demand doesn't outstrip supply for these types of products like high bandwidth memory. So I think the earnings are going to be great, but I just think given the environment, I think everybody's a little bit more sensitive. So I would lean that the likelihood is that you probably get some kind of a sell on the news at some point. Even if you gap up tomorrow and you're in the stock, I think you still have to be on high alert that where do we close on that day? Where do we close on Friday? You have to be, this is how sensitive the environment around chips is right now.
Yeah, and I mean, look, these stocks have had an incredible run into this anyway, and as JP Morgan put it, with this 7,800 euro target, this rally won't be linear. I mean, certainly until the end of the year. And just sort of finishing things off with use case, the use case strong markets can make financial lives more complicated, not simpler. I want you to sort of break that down for us. I mean, this positioning right now in this market.
I'm no great Gatsby, but this sure has felt like the roaring 20s so far. What that means is that we've had more millionaires, more billionaires, and as you know, right now we have a trillionaire. So the wealth effects is very much, we've seen this acceleration in their wealth over the last 6 years, And now it's a question of how do you manage that wealth. And so, as you noted, when you have more money, your financial life becomes more complicated. We're trying to help our clients make sure that they understand some of the risks that can come in having that type of wealth, such as concentrated positions. When you have tech stocks that have been ripping so aggressively for a long time, that can be a large portion of your portfolio. We define concentration as anything more than 10% in a total portfolio. The other aspect is around tax consequences. And we want to make sure that our clients are understanding diversification is a very important key right now. Again, as we keep talking about the sensitivity, this is why we want to make sure that we are thinking more broadly than how do I chase, the biggest fad, how do I avoid, the AI theme. It really is making sure that you've got a broad range of investable ideas.
Gentlemen, thank you so much for joining me today. Really appreciate your thoughts. Nathan Peterson, Director of Derivatives Analysis, Scott Fitter for Financial Research, and Casey McCurdy, who's the Chief Portfolio Strategist.
So yung Boglins magkano? $7,300 stock price. I don't have the ability to sell premium in here. I can trade spreads in here. I can use calendar spreads, some diagonal spreads in here. But sometimes the stock price is the determining factor of your strategy. So keep all this in mind and just really make sure if you're selling premium, you need to be able to withstand the variance of any kind of move. I prefer to, if I'm selling a put or a strangle, let's talk about puts. If I'm selling a put, I would rather sell it in a product where I can just hold that premium or take the shares. I would rather not exit at 2 or 3 times the loss of that short put, because if I'm selling an undefined risk put, I kind of want to have that bullish delta anyway because it does get down there. I don't want to be stopping myself out and then 2 weeks later see that it could have moved out of the money. So that's just me. But to summarize, if you're buying options, you get what you pay for. I think in this kind of market environment, I'm always going to have something against it. Like if I'm buying a 60-day option, I want to be selling something in the 30-day cycle and maybe the weekly cycle against it. If there's an earnings announcement where that premium is really juicy and I can reduce the cost basis on my long option, because the more you can reduce the cost basis on your long option, the more flexibility you have going forward to have that long option be profitable or even a scratch. If I'm selling premium, I'm very cognizant of the fact that it is a higher probability trade. You're going to have a lot of winners when you're selling premium, but you should also understand how to manipulate that trade. With defined risk debit trades, when you're buying premium, there's not a lot of things you can do. There are certain things, like with calendar spreads and diagonal spreads, where you can manipulate that short option by moving the strike or moving it out in time. But with short premium, undefined risk short premium specifically, you can do a lot of different things. You have a ton of flexibility in the ability to manipulate strikes. And if you look at my order change for the MES position, this is my year-long strategy for 2026. I've clearly manipulated this position over and over and over. And every single time I do it, I collect more credit. I started with 93 points in credit. I now have 700 points in credit overall, which means my break-evens are 700 points beyond my strikes. And this is a profitable trade because I've been selling premium to offset any kind of intrinsic value losses that might show against me. So short premium, I like to reserve it for either products that I can afford any variance in, or something in like an index, like MES is a great example, or IBIT. I like to keep them within $500 to $1,000. I think that's a healthy level for me. But again, if I'm doing a diagonal spread or calendar spread, I have a plan for if things go wrong. I know I can move that short strike out in time. I know I can move that short strike up or down depending on the strategy. But yeah, let me know what you think in the comments below. That was a long-winded segment. Wasn't expecting to go that long, but hopefully that kind of mental shift helps a little bit. Again, if I'm selling on the Finder's Premium, it's usually in an index product or a micro futures product, and it's sector-based. It's not something that's going to move 20% pre or post market, but if I am involving myself in those types of products, it's going to be in a product size that is small enough to where I can withstand any variance. I can manipulate the strikes up and